Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Walgreens stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Walgreens Boots Alliance is a holding company that owns the retail pharmacy chains Walgreens and Boots. This entity was formed in 2014 when it acquired the remaining 55% of Alliance Boots, giving it 100% ownership. Walgreens operates the second largest pharmacy chain in the US behind CVS. Its specialties are filling prescriptions, health and wellness products, health information, and photo services. It has over 9,000 stores in the US. Boots is a pharmacy chain with 4,600 retail stores across 27 countries. The company is headquartered in Deerfield, Illinois, and was founded in 2014. But Walgreens' history dates back to early 1900s. The ticker trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Xetra, Vienna, EuroTLX, Swiss, and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 37 billion market cap. They're trading at $43 a share, and they have 864 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive and consistent free cash flow each year, around $3.5 to $4 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows a lot in the trailing 12 months, over $6 billion. Revenue is a sales for the company, and that's as steady as you can get. It's between $130 and $140 billion a year. So it does appear that revenue is not growing, but that's still a huge number, $136 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. The cost to maintain their stores, the rent, the employee costs, the cost to purchase all the products, that's all part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that's $30 billion in the trailing 12 months. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. An example is payroll for support functions. The CEO's salary will go into operating expenses. Gross profit minus operating expenses give you your operating income, and that's $4.2 billion in the trailing 12 months. They do have a lot of debt. They spent over $800 million of interest on their debt, which is lower than 2021, but a lot higher than 2020 and 2019. Then you have your pre-tax income, then your taxes, then you have earnings from equity interest. So if Walgreens owns between 20% and 50% of another company, they report that company's profit or loss onto their income statement. For example, if they own 1/3 of another pharmacy chain, and that chain reported $900 million of profit on their income statement, Walgreens would report $300 million of profit in this category. And if that company reported a $900 million loss on their income statement, then Walgreens will report negative $300 million in this category. And you can see that's below tax. Earnings from equity interest does not get taxed. And the bottom line of the income statement is their net income, which is really high in the trailing 12 months, over $6 billion. The main reason it's so high is this big gain in other income and expenses, over $3 billion. That's mostly the gain on an investment. Items in other income and expenses are usually non-recurring. Plus, they're not part of the company's core operations. So I would just focus on operating income when I look at the income statement. This is the company's income statement directly from their financial reporting. The income statement we just looked at was from Yahoo Finance. So for the 3 months ending February 2022, they had sales of $34 billion, cost of sales of $26 billion, so gross profit of close to $8 billion, which is higher than 2021 of $7 billion. Selling, general, and administrative was $6.6 billion, so their operating income is up a lot, about 50% from the prior year. But their net income is lower. It's $200 million lower than 2021. That's mainly other income and expenses. In 2022 it was negative $200 million. In 2021 it was positive $250 million. That's a $450 million swing. But the 6 months ending February 2022, their sales were about 5% higher than the prior year, but their net income was a lot higher. Most of it is due to that gain in other income and expenses of $2.4 billion. But if you strip that out, their net income is still a lot higher than the prior year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Cash flow eliminates a lot of accounting items, so it smooths things out. Because you could see the income statement was a bit volatile, but their operating cash flow is pretty steady year to year. I feel operating cash flow is a much better indicator of how the company's doing than net income. They spent about $1.6 billion in CapEx. Every time they open up a new store, the cost to purchase the real estate and the cost of all the equipment that goes into the store is all part of CapEx. Operating cash flow minus CapEx gives you your free cash flow. And that's pretty consistent year to year with $3.6 billion in the trailing 12 months. Since they have so much free cash flow, they pay a nice dividend. They also buy back stock each year. They didn't buy back that much stock in the trailing 12 months in 2021. They bought back a ton in 2019, over $4 billion, $1.6 billion in 2020. When a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. And since 2019, it looks like they paid down a little more debt than they issued. This is the company's operating section from the statement of cash flows. And to calculate operating cash flow, you start with your net income. That was $4.3 billion. We add back depreciation and amortization of $1 billion. We minus out that gain of $2.6 billion. And then we adjust for changes in working capital. So their operating cash flow was a lot less than their net income. It was $2.2 billion. Last year, their operating cash flow was a lot higher than their net income, because last year they didn't pass through a big gain on an investment. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. Even though they generate a good amount of cash flow, it's a pretty small percent of their revenue. Pharmacies have pretty low margins. Not as low as supermarkets, but they're pretty low. Their revenue hasn't gone up too much in the past 6 years. It's fairly steady. But if their revenue was $10 million and it wasn't going up, that's a problem. But when your revenue is over $130 billion, even if it's flat, it's still a ton of revenue. This is their investing and financing section from the statement of cash flows. This is the 6 months ending February 2021, and this is the 6 months ending February 2022. They spent $900 million in CapEx. Last year was $700 million. They received $500 million from a sale leaseback transaction. Say, for example, you had a mortgage on your home, but you were having difficulty paying the monthly payments. I could buy your home and then lease it back to you, so you would pay me as if I'm the banker. That's a sale and leaseback. They spent $1.9 billion in business acquisitions. Last year it was $1.3 billion. So they had a cash outflow of $2.2 billion in their investing section. In their financing section, they added $1.3 billion of debt. They added another $10 billion of debt. They paid down $7.3 billion of debt. They acquired $2.1 billion of a non-controlling interest. Say, for example, they own 80% of company X. 20% of that company is held by someone else. It's a non-controlling interest. They don't control 20% of that company. So it appears they bought back that portion of the company they do not own. And they spent $833 million of dividends. Last year was $808 million. So in their financing section, they had a cash inflow of $770 million. Last year was a cash outflow of $650 million. Let's look at the capital structure. $27 billion of equity, $37 billion of debt. They're 42% equity, 58% debt. I gave them the highest whack on Finbox, 6.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $56 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $56 billion. We divide that by 864 million shares. And we get a calculated stock price of $65. They're trading at $43, so they're trading at a 33% discount. It's a buy according to the model. So I took a really conservative approach with this model. I decreased their revenue 1% a year for the next 4 years. The company forecast is for their growth to be around 2 to 3%. And they convert 3% of their revenue into free cash flow, so I multiplied their future revenue estimates by 3%. That's how I got their future free cash flows. Because when I did prior videos for this company, my valuation came really high. So I'm trying to tinker around with my model to make it more in line with the market. The website Simply Wall Street's valuation is 140. They're saying it's 69% undervalued. 8 analysts priced this stock and the average price target is $50. The low is 46, the high is 56. This is where the stock has been trading the last 5 years. So you can see it was doing a lot better in 2017, 2018, and 2019. Then it started to really come down well before COVID. And it looks like it was around $30 at its low point. It came up to about 55, but it has come down since that point. And it looks like it's trading at its 52-week low currently. If you invested in the S&P 500 5 years ago, you'd be up 92%. With this stock, you'd be down 47%. They have a low beta 0.56, so the stock moves half the market. Their stock has gone down 22% in the past 52 weeks, while the S&P is up 11%. The 52-week low is 43, the high is 56. And the stock is trading below its 50-day and 200-day moving average. Over 9 million shares are traded each day. Of the 864 million shares outstanding, 714 million are on float, 59% are held by institutions, and 2.5% of the shares are shorted. They do pay a nice dividend. That's why most people buy this stock. It was 40 cents in 2017, but they raise it every year. It's up to 48 cents. Their dividend yield is close to 4.5%. Which they can easily afford. That's 45% of their free cash flow, 27% of their net income. You can see the 80s and 90s were the heyday for this stock. They did 7 2-for-1 stock splits in those 2 decades. Their employee count has been declining over the years. It was about 360,000 back in 2015. Now they're at 260,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $17,600 today. That's a 6% annual return. Only one insider activity in the past 12 months, a sell of 2,700 shares. 58% of the company is held by institutions, 25% by the general public, and 17% by private companies. The CEO of Walgreens controls this fund, NewSip. They own 17% of the company. The next biggest shareholder is Vanguard, BlackRock, State Street, and Capital Research. Let's look at their financial ratios. A PE of 6.1, that's stock price over earnings per share. The market median is 20 and the average is 30. Below 15 is considered a good value. A price to sales of 0.3, that's stock price over sales per share. This means their revenue is more than triple their market cap. And a price to book of 1.4, that's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet, it's assets minus liabilities. But if you look at their tangible equity, it's negative 7.6 billion. Due to all the acquisitions, they have lots of intangibles on their balance sheet. Their price to free cash flow is 10.3, that's stock price over free cash flow per share. Let's look at their non-current assets, 12 billion of PP&E. They have 22 billion of operating leases, right-of-use assets. This is the value of the assets they pay lease payments on. So we'll see their lease payments in their liability section. Goodwill of 22 billion. Goodwill is the premium you pay when you acquire another company. 12 billion of other intangible assets. 6.2 billion of equity method investments. These are their investments in other companies. Generally, a company uses equity method accounting if they own between 20% and 50% of another company. And 1.4 billion of other. This is their non-current liabilities, 11 billion of debt, 22 billion of operating leases, 1.9 billion of deferred income taxes. This should increase their tax bill in the future, and 3.3 billion of other. They have a low ROIC of 5.5%. They do have a lot of debt, but they can cover the interest payments on their debt more than 5 times. A high ROE of 23%, a lot higher than a market median and average. They can cover 70% of their current liabilities with their current assets, and their quick ratio is really low at 0.3. Let's look at their current assets. 1.9 billion of cash, 5.3 billion of accounts receivables. This is how much money others owe them. 8.9 billion of inventory and 660 million of other. Let's look at their current liabilities. 2.1 billion of debt, 11.2 billion of payables. This is how much money they owe others. They owe 2.3 billion on their operating leases within the next 12 months, and 7 billion of accrued expenses. These are expenses the company has incurred, but it has not paid it yet. They generated 3.6 billion of free cash flow in the trailing 12 months, but they have negative $5.9 billion of working capital and they paid out $1.7 billion of dividend payments. So it looks pretty likely they're going to need to add some debt over the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 13 companies in the same industry as Walgreens. The reason CVS is not on this list is because they're in the industry healthcare plans. Walgreens is by far the biggest company. If you sum up the other 12 companies and multiply by 10, it's still smaller than Walgreens. So they're better in every single category except their growth rate. They're pretty flat in their growth. The average is 34%. But it is a lot harder to grow when you have over $100 billion of revenue compared to a lot of these companies that have under $1 billion. Although Rite Aid has a decent amount of revenue at $24 billion. They're growing at 4%. But Walgreens has better price multiples in all the categories. So that does indicate the stock is undervalued if you just look at the price multiples. So to summarize, I have them trading at a 33% discount. And I think this is a great long-term hold. You get your stable dividend. The company's going to always be around. And they're getting a little more prominence from COVID. I personally went to a Walgreens to get my booster shot. They've done tons of COVID tests and shots. So they really do add a lot of value to the community. Because the stuff they sell, you can't live without. I rank their free cash flows 5 out of 10, their revenue 5 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.